ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም። ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ትችላላችሁ።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ልምድ ባላቸው መምህራን እየተማራችሁ ጥያቄና መልስ፣ የክፍል ስራዎች፣ ፈተና መፈተን ክፍል ውስጥ እንዳላችሁት አይነት በኦንላይን ባላችሁበት ቦታ ከናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
All right. Yesterday we introduced the portfolio analysis and the management, and we looked at various aspects of investment. For example, the investment vehicles, the types of investment. We have basically 2 types of investment: financial asset investment and physical asset investment. We also looked at the requirements. One, the prerequisites for one to carry out an investment analysis. What you need to be acquainted of. For example, you need to understand the market. You need to understand the environment, the investment environment, so that you can make informed decision. And it can also help us get the right data that we require to analyze for information for decision-making purposes. That's where the accounting aspect comes in. And you remember when we started, we were looking at the accounting ratios. And we saw that there are actually tools that can be used by managers to help them make decisions. So we looked at a number of them. And when we talk about data that helps us to make informed decision about investment, then we cannot forget the accounting information that is normally used to compute ratios that help us in making decisions. So we want to continue from there, and just allow me to share the screen so that we continue from where we had stopped. All right. So characteristics of financial assets, because that is where we are going to focus on a lot. We saw that they are divisible. They're easily divisible. That means you can easily sell part of your holding. For example, if they are stock or shares, you can sell part of the shares and retain part. So that is the divisibility aspect you're talking about, and it's very easy for financial assets than physical assets. Then there are also marketability. They have marketability quality. That means the liquidity, you can easily convert them into liquid cash as opposed to physical asset. So that is another advantage of investment in financial assets. Then another quality for investment in financial assets is the information availability. So we saw that information availability is also paramount for this, for trading. So it makes it easier for trading in this kind of shares or stock or investment much more easily than the physical ones. And like I gave the example of the stock exchanges, they normally give an up-to-date information about the transactions, the business, the shares of different companies, how they are trading on the stock exchange. And this information is relayed on a timely basis, all right? Hourly basis, daily basis. So it's even printed in the media, so that one, you can be well informed about some of this information that is relevant for decision making about investment in this area. All right, so we were to continue from there, and the next area we're going to look at were the main types of financial investment vehicles. So we have short-term investment vehicles, we have fixed income securities, we have common stock, we have speculative investment vehicles, and we have other tools. All right, so short-term investment vehicles. These are all those which have a maturity of 1 year or less. All right, they are those investments that take a very short time to mature, and they are normally used in the day-to-day trading activities of businesses. So that's why they have to be, the maturity period is less than 1 or is less than 1 year or within 1 year. Most of them go for 3 months. All right. Things like fixed deposits. When you invest in a fixed deposit, you expect returns or interest earned on a quarterly basis. All right, so that is short-term investment. Short-term investment vehicle often are defined as money market instruments because they are traded in the money market, which presents the financial market for the short-term marketable financial assets. So these are financial instruments that are used in particularly this area, and you can mention many of them. Promissory notes, those are some of the like fixed deposits, you know. So the risk as well as the return on investment of short-term investment vehicles usually is lower than for other types of investments. So in finance, the longer the period of investment, the higher the risk, and the shorter the period, the shorter the risk, or the lower the risk. Take, for example, if you take a loan from the bank, and banks give different periods under which you can repay back your loan. You realize the sooner you pay back your loan, the lesser the interest, right? So this is, and the longer period you take to repay your loan, the higher the interest that you end up paying, right? And this is just because of the time element here. Risk is normally high because the future is so uncertain. We cannot predict the future easily, but the short-term period can always be predicted, and therefore, if there are any risks that may be forthcoming, can easily be predicted or expected to occur within that short period of time, and therefore, you can we are in better place to cushion ourselves against that. The main short-term investment vehicles are certificate of deposits, treasury bills, commercial paper, bankers' acceptances, repurchase agreements. You know, these are just, of course, assuming it's a bank and is giving like a commercial paper, it attaches some interest, isn't it? So when you are giving commercial paper, then the returns, whatever interest that or commission that is payable for that paper is actually the return we're talking about. So this is now what we're talking about as in terms of the short-term investment vehicles. So, so under short-term investment vehicles, we can have certificate of deposits, treasury bills, commercial paper, bankers acceptance, repurchase agreements. So it's good to cite some of these examples so that you make the point reach home as expected. Then we have fixed income securities. These are those which return is fixed up to some redemption date or indefinitely. All right. So we have different types of fixed income securities. We can talk of preference share capital. We can talk of debentures. All right. Debentures, for those ones who have done some accounting, you understand what a debenture is. So the company sells or issues a certificate to the lender. And that certificate is actually a recognized document to show that the lender has actually given money to the company, and the specific period of maturity is indicated. Or if it's not mature, the maturity period is not indicated, then it means it is indefinite, but it's always expressed in the document. The interest rate is fixed, all right? Like you will see when we record our debentures in our books, we record starting with the rate of interest, and which is payable on annual basis or quarterly basis, depending on the agreement. So these are some of the things that we're talking about in terms of fixed income securities. Ordinary share capital are not fixed income securities. Don't confuse that, because their dividends is not a prerequisite. You know, they are not supposed, it's dependent on whether the directors declare to pay dividends or not. If not, then they are not, all right? They are not fixed income securities. So a long-term loan can be a fixed income security because you earn interest over the long period that you've advanced the interest or the loan. Now, when we talk about some of the things, look at it from both point of view. It could be an individual, because in the introduction we talked about the people or the participants. We have two types of groups that can invest. We have individual and institutions. So an institution can also borrow or can also advance a loan. An individual can borrow or can also advance a loan. So look at it from that perspective. So an institution can be a company, an institution can be a bank, all right? Can be a company borrowing money, right? Can be a bank advancing money. So we are all in investment because you borrow for a reason why you are borrowing, all right? Probably you want to finance your operations as a company. So there are ways and there are different perceptive and perceptions of looking at this, all right? But they all refer to the same style of, vehicles that we are talking about. The fixed amounts may be stated in the money terms or indexed to some measure of the price level, all right? So that's why I'm saying it's normally indicated in advance. As you are investing in that, you already know the rate of interest that is expected from that return or that investment, and that's why you can always predetermine whether it's a viable investment or not. All right, because you can plan for the interest in advance. And then other than that, you need also to look at the risk, because we mentioned is the return and risk, all right? The quantitative representation of these aspects of investment, the returns and the risk. Then this type of financial investments is presented by two different groups of securities. We have long-term debt securities and preferred stocks. So long-term debt securities, I mentioned like debentures, like yes, a long-term loan. So these are normally long-term in nature, and they have a fixed rate of interest. All right. Preferred stock have also a fixed rate of dividend. Preferred stock, the return on preferred stock is dividends, but the dividends are fixed because the rate is known from the word go. All right. Now, there are different classes of, you may find different classes like we have talked about redeemable and irredeemable. All right. Those ones that have maturity period and those ones that do not have maturity period. So that one also is very important because we have to apply the necessary model depending on the nature of security we are handling. Long-term securities have maturity longer than 1 year. The buyer who is the investor of this security is lending money to the user. That is supposed to be a user, not the insurer. Issuer. It's lending money to the issuer. Okay, sorry, issuer. Issuer is the company giving or issuing those certificates, the like debenture certificates. Then who undertake obligation periodically to pay interest on this loan and repay the principal at a stated maturity date. So it's just like a loan. You could look at it from that perspective, and the way a debenture operates, because it has interest that is payable on annual basis, and then there is also the principal, which is payable probably at maturity date. So these are some of the contractual agreements that are spelled out in the contract or in that document. Long-term debt securities are traded in the capital markets. So they are traded in the capital markets, like debentures. These are traded in the capital markets because they are capital in nature. All right. They are not as much as short-term are more of liquid or liquidity decision. These ones are more of capital decisions or long-term decisions. Then we have the common stock. This is an investment vehicle, which is one most popular among investors with the long-term horizon of their investment. So common stock is just the ordinary share capital. And when you buy this, essentially you become like a owner of the company, part owner of the company. And there are most common ones, and they are highly traded in the most stock exchanges. All right. So this is a vehicle which is normally used by people who are investing in companies. All right. Common stock represents the ownership interest of corporations or the equity of the stockholders. All right. So they are like the owners, like we've said, the owners of the company once you acquire some of these shares. Holders of common stock are entitled to attend and vote at a general meeting of their holders, to receive declared dividends, and to receive their share of the residual assets. Their return on common stock is dividends. All right. I'm sure you've heard a lot about dividends and this issue of shareholdings and all that. So they are entitled to dividends, but it's not a mandatory So it all depended on whether they have reported profits or not, and it's normally declared out of profits. We have also the residual. You know, once you become an owner, once you buy a share, you become part of the owners of the company. Therefore, you come last when it comes to sharing of the remains. After all other creditors have been paid. The issuers of the common stock are the companies which seek to receive funds in the market and though are going public, all right? So companies that are listed on the stock exchange are public companies because anybody else can become a shareholder by buying shares of that particular company. So once a company is listed, then it becomes a public company, which means you and me or anybody else can become a shareholder by buying shares of that company. The issuing common stocks and selling them in the market enables the company to raise additional equity capital more easily when using other alternative sources. So it helps the companies raise capital or equity capital because, as I'm saying, once you buy these shares, you become a shareholder and therefore you are a member of that company, all right? So when the company sells those shares or when they're issuing shares in the market, then they are in a way trying to raise capital that they can use to fund their operations or their investment. So one of the ways of raising capital, as we saw in our last discussion, is when the companies issue shares, it's a way of trying to raise funds to finance their investments, all right? When you are looking at the financing decisions by the managers, then that is one of the areas that they have to look at in terms of trying to raise capital to finance their investments. And as you saw, we've seen up there, they are also long-term in nature, all right? They're long-term in nature. People, when they are buying for investment, then they tend to hold those shares for a longer period than the short-term instruments that we've talked about. Now, the issuing, okay, thus many companies are issuing their common stocks, which are traded in the financial markets, and investors have a wide possibilities for choosing this type of securities for their investment, all right? So once the companies are listed on the stock exchange, then it means people who may be interested in different companies are can freely sell shares of the companies they're not interested in and acquire shares of a company that they may be interested in. So these are some of the marketability issues we are talking about when you talk about the financial asset investment. Okay. We also had the speculative investment vehicles. This could be defined as investments with a high risk and high investment return, all right? Speculative, just like the name sounds, you are speculating, all right? For example, there are those brokers who buy shares and speculate that the price may increase in the near future, and then they dispose them off to make some capital gain. So there are people who are in business for that, and they do that. They rely basically on the speculations. So the risk is high because things may turn the other way around, all right? and you end up making losses, or if there are losses, then you make huge losses. So, so you must also understand the market, just like we've mentioned. You must also understand the market so that you do the right speculation, right? You do the right speculations. There are those indicators that help you to speculate well, so that you minimize the losses and try to maximize on returns, because that is the bottom line. Using these investment vehicles, speculators try to buy low and to sell high, all right? So they try to buy low and sell high. And the difference between the price they are buying at and the price they are selling at is now the gain that they are making out of such speculative investment vehicles. Now, their primary concern is with anticipating and profiting from the expected market fluctuations. So they actually play around with the fluctuations in the market, like those who deal with the forex bureaus, all right? They have currency of a different nation, but they are selling them at some, exchanging them at some price, because they anticipate probably the price will be high, and they have to understand the market for them to do well in that area. All right. The only gain from such investment is the positive difference from selling, or between selling and purchasing prices. All right. Speculative investment vehicles could be presented by these different vehicle options. So we have different vehicles. Examples of speculative investment vehicles: we have options, we have features, we have commodities traded on the stock exchange, like coffee, grain, metals, and other commodities. So you find people buying goods from one town to go and sell in another town because of just the difference in price. You might find that the huge difference in price. So when you buy in bulky, you maximize on the profit. All right. So these are the tradings that are happening in the markets. And for you to do well, you must be aware of the prevailing prices in different locations, so that you can take advantage of that to make some gains. All right. Now, other investment tools, this may include various types of investment funds, like investment life insurance, pension funds, hedge funds. Now, all right. This, in most cases, they are pooled investment, where different savers come together, and then now the investment is done like the mutual one that we saw. So pension funds is actually what you are contributing on a monthly basis towards your retirement. That fund can be invested elsewhere, and the returns can be shared amongst the contributors. So these are some of the investment vehicles that we can talk about. So it's good to be in position to explain some of these vehicles and probably give examples like we have done in this particular discussion. Any question? So we have actually analyzed all the four. There are four, right? There are 1, 2, 3, 4, 5. There are 5. So make sure you are in position to explain the 5 key investment vehicles that we can use, and particularly for financial assets. Any question? Kadir, do you have a question? Girma, you have a question?
No, I don't have.
Okay. All right. All right, if no question, then we can continue. The next area we're going to talk about is the investment management process. We are looking at investment analysis and management, or investment management and analysis and management. So it starts from some objective, set objective, right? Every analysis that you have to make, or every decision that you have to make, then it always starts with a set objective. You cannot make a decision from loose, all right? You have to have some basis for making that decision. And this basis is what you're talking about as objective. So there are various steps that we need to follow as we go through this analysis and management of investments. So investment management process is the process of managing money or funds. The process of managing money or funds. All right. So, and as we look into this, the bottom line why we do investment is to maximize returns and minimize risks. So even that is the essence of portfolio formation. We want to maximize returns, but at the same time, minimize risks. That's why you have to diversify your investment. So in a way, you are trying to manage your money properly so that you lose the risk. You reduce the risk of losing a lot of money through other means like putting your money in a wrong investment. So the investment management process describes how an investor should go about making decisions. How an investor should go about making decisions. The steps involved in making decisions. So we can come up with basically 5 key steps that we can be involved in as we try to manage our investment, all right, or investment management process. So this include, 1, we have setting of investment policy. So setting of investment policy, this will include now the objective, because organizations are actually guided by policies. There is no organization that is operating without policies. So even investment, there are policies that go with the investment for that organization. Otherwise, management would become so difficult for this kind of investment or for the different functionals of the organization. So policies are very important. That's why even in government, we have policies. And policies guide the way we do things, or the way we should do things. So now the first step is setting an investment policy. So the investment policy, there's much you can read about setting an investment policy. How do you set an investment policy? What are the key factors that you need to consider for you to come up with a proper investment policy or a viable investment policy? Then number 2, we have to have analysis and evaluation of investment vehicles. Now we've talked about investment vehicles. So things like portfolio analysis, project capital budgeting, those are part of analysis and evaluation of investment vehicles. Because you have different projects or different assets or different investment projects, but you need to invest in 1 or 2 of them and leave out the others. So you must have a way of taking the one that is right for you to invest in and leaving out the others. So this is part and parcel of analysis and evaluation of investment vehicles. Then number 3, we have formation of diversified investment portfolio. So the formation of diversified investment portfolio has its own criteria of looking at this. So you don't just wake up and then say that this project and this one, these are the ones that we can form. So there's a procedure that we go through that, and which is part of the analysis, and which will give us now the right portfolios or the right projects that we need to combine and can form a beautiful portfolio that will maximize our returns and minimize risk. Then after that, we have portfolio revision. Just like any other investment or any other undertaking, we don't stop there. We have to keep on revising, because the market is not static. The market is dynamic. There are a lot of fluctuations in the market. So we don't expect those fluctuations not to affect our investments, because where are we investing? We are investing into the market, all right? So if you are investing into the market, then it means anything that is happening in the market is likely to affect our investment. And therefore, it calls for revision so that we move with the market, all right? We move with the market. And that's why I said, and part of parcel of this course is to understand the market, because that's when you can now make informed decisions. If you don't understand the market, then you will not be in position to make the right decision or the right investment decisions. So this is one of the areas that will call for revision, constant revision, because we are operating in the market that is so dynamic. The technology is changing. So once you invest in a project, do you just stay back? You know, you have to keep pace with the technology, all right? Otherwise, you'll be thrown out of the market. Then there's measurement and evaluation of portfolio performance. So we have to keep on measuring and evaluation. Evaluation does not stop at the beginning of the implementation of the project. It's a continuous process, all right? And just the same reasoning, because the market is not static, things are bound to change. Therefore, we have also to continue measuring and evaluating our projects in terms of returns, in terms of risk, all right? So this is also a continuous process. And sometimes when you do evaluation, you may decide to abandon some projects and pick up the others, isn't it? So that is only done through evaluation and measurement and evaluation of the portfolio. Because this time it may be, the returns may be good, but it may reach some point where the returns may not turn out to be good, right? So you don't just sit back, but you have to keep on evaluating these projects or these investments. Now, probably we'll go one by one just to understand or to appreciate the key steps that we're talking about. Now, like setting of investment policy, this is the first and very important step in investment. The first and very important step in investment. Okay, why? Because in every decision that you make, you must have a set objective. Management process, investment policy includes setting of investment objectives.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Okay, so we are saying This is the first and very important step in investment management process. Investment policy includes setting of investment objectives. Now, the investment policy should have the specific objectives regarding the investment returns, requirements, all right, the investment return requirements and risk tolerance of the investor, all right. So these are now the key facets of the policy that we may want. It should be one that is guiding us on the returns, and is one that is guiding us on the risk, because we cannot eliminate risk totally. That one is impossible. We cannot eliminate risk totally. In the market, we cannot eliminate risk totally. So there must be an element of risk. So now the issue is, what levels of risk can we work with? So there are the risk tolerance levels that we need to set as part of our investment policy. Then same to returns, all right? We cannot always be looking at the highest returns, all right? Sometimes we must have a safety range where we're talking that the minimum return that is acceptable is this. So that is part of the policy. So every organization has a policy, and for you to come up with those limits, then you must have done some market analysis, all right? You must have looked at, you've done a SWOT analysis with yourself. You know your strength, you know your asset base, so you can only absorb up to a certain limit of risk, and you can only accept a minimum return of this. So that is an investment policy that we have to set, so that as you make decisions as managers, as you do evaluation and measurement of the asset, then the decision that you make must fall within those acceptable regions by the organization. So that is actually very important, and as you can see, is the first step towards investment analysis and management. The next step is analysis and evaluation of investment vehicles. Now, when the investment policy is set up, investors' objectives defined and the potential categories of financial assets for inclusion in the investment portfolio identified, the available investment types can be analyzed. All right. So this is basically what you are going to do a lot in terms of trying to evaluate, to analyze and evaluate different projects, all right, and selecting those ones that are viable according to the investment policy of the organization, and leaving out those ones that are not viable according to our investment policy. Okay, so the market is too wide, and there are various options in the market. There are various investment alternatives in the market that you can go for. But the important thing is, are we able to select the ones that are actually viable for us at any given time? So that's why we have to understand some of these procedures of evaluating and analyzing projects. This step involves examining several relevant types of investment vehicles and the individual vehicles inside these groups. So this is typical of the portfolio, because we don't look at the portfolio in terms of the projects that belong to that portfolio. But we look at more than that, we look at also the combination. There are projects that cannot combine. There are those ones that can combine, all right? So, and I keep on reminding you, the bottom line is minimize risk, maximize on returns. Okay, so those are some of the things that we do under analysis and evaluation of investment vehicles. Then we have technical analysis. Technical analysis involves the analysis of market prices in an attempt to predict future price movements for the particular financial asset traded on the market. Okay, so we need to come up with expected returns, all right? And we look at this, we can only do this if we understand the market and we can predict the market, all right? Of course, when you do some regression analysis, you'll be able to come up with the model that will help you predict some of these things you're talking about. Of course, using the historical data or financial information for that matter, we're able to come up with some of these projections that will help us evaluate projects in terms of returns and risk. This analysis examines the trends of historical prices and is based on the assumption that these trends or patterns repeat themselves in the future. All right, they repeat themselves in the future. So that is the basis of coming up with some of these predictions, because the assumption is the future is judged by the history. All right. So if you can see some trends, all right, you do some trend analysis and you see this is the way the market is likely to behave, then you can easily use that basis to determine the expected future returns. The fundamental analysis in its simplest form is focused on the evaluation of intrinsic value of the financial asset. What is intrinsic value? So we look at the interest. For example, the interest that is payable for this asset. All right. We look at probably the dividend that is actually payable or expected for this asset. So those are now the intrinsic costs or the intrinsic value of the asset. So those are important for analysis purposes, so that we're able to make or come up with informed decisions about this investment. This valuation is based on the assumption that intrinsic value is the present value of future flows from particular investment. The future flows from particular investment. If you recall, when we are looking at capital budgeting, we are looking at the cash flows and then the cost of the investment to determine probably the net present value. So that is the future returns or the future flows are actually predicted based on that. Then by comparison of the intrinsic value and the market value of the financial assets, those which are underpriced or overpriced can be identified. Now, along the way, we'll be able to identify projects that may be underpriced and those ones that may be overpriced by evaluating the projects based on probably the CAPM model, because it helps us identify the underpriced and overpriced assets. So we look at that and see how we can, particularly for those speculators, you see when the stocks or the securities are underpriced, right? Then they buy. But when they are overpriced, they sell so that they gain. You know, those are the mathematics that they play around with so that they make some gains. Now, the other step was the formation of diversified investment portfolio. Now, investment portfolio is the set of investment vehicles formed by the investor seeking to realize its defined investment objectives. Okay. Now, the investment objective is the same as trying to fulfill the investment policy requirements. So this is where now the formation of portfolio comes in, because you have to diversify the risk and maximize on returns. In the stage of portfolio formation, the issues of selectivity, timing, and diversification need to be addressed by the investor. So timing, selecting projects using some criteria, diversification needs to be considered as much as we have to come up with a portfolio. So it's not a question of just deciding which to take and which one not to take. We must have a basis. Selectivity refers to micro forecasting and focuses on the forecasting price movements of individual assets. Are we in position to forecast the prices or the returns from this investment that we need to analyze? Okay. Timing involves macro forecasting of price movements of particular type of financial asset relative to fixed income securities in general. So like if there are fixed income securities like debentures or preference shares, the rate will always help you determine the future inflows from those investments. Okay, so that it becomes easier for you to forecast. Diversification involves forming the investor's portfolio for decreasing or limiting risk of investment. So that's the purpose of diversifying, to limit the risk of investment. We are told we don't put all our monies in one basket. Okay, it's good to put them in different baskets, so that by doing that, you are maximizing the risk. You are minimizing the risk of losing all of them in case one breaks. The techniques of diversification are random diversification, when several available assets, financial assets, are put to the portfolio at random. All right. So there are those who do it randomly without doing any analysis. All right. And probably at the end of the day, they gain. All right. But there are those who do objectively. So we have random portfolio diversification, and we have a objective portfolio diversification. So objective portfolio diversification, when financial assets are selected to the portfolio following investment objectives and using appropriate techniques for analysis and evaluation of each financial asset. So you must note this difference. All right. There is the objective diversification and random diversification. Okay, so this is important to note, so that there are people who just use random, and then they go through it well, and there are those who may do that and then they end up making losses because they are not using any objectives or set analysis or applying any technique in selecting some of these projects. Now, okay, objective diversification, when financial assets are selected to the portfolio following investment objectives and using appropriate technique for analysis and evaluation of each financial asset. Investment management theory is focused on issues of objective portfolio diversification, and professional investors follow settled investment objectives for constructing and managing their portfolios. Okay, so we actually advised that we go for objective diversification, because that, in a way, you are assured of minimizing your risk, and you are sure of what you are undertaking, and you can also plan for it, all right, in terms of financing, all right, and in terms of the returns that you anticipate to get from that investment. Okay, so this is under formation of diversified portfolio. The next one is portfolio revision. This step concerns with the periodic revision of the three previous stages. All right, the three previous stages. The three previous stages were policy, all right, formation, analysis, isn't it? This is necessary because over time, investor with long-term investment horizon may change his or her investment objectives, and this in turn means that currently held investors' portfolio may no longer be optimal and even contradict with the new settled investment objectives. Policies have to keep on being reviewed. So to investment policy. So as much as we are reviewing that, then that calls for us to review our portfolios. Okay, so this is what we are being told, that this being a long-term nature of investment, then we need to be conscious about the revisions that may take place and act accordingly and timely. So this is very important. Investors should form the new portfolio by selling some assets in his portfolio and buying the others that are not currently held. So as a matter of revision, you can decide to sell off some of them and buy some of them to your portfolio. It could be the other reasons for revising a given portfolio. Over time, the prices of the assets change, meaning that some assets that were attractive at one time may no longer be so. Thus, investors should sell one asset and buy the other more attractive in this time according to his or her evaluation. Okay. This one is self-explanatory because we are just trying to expound on what we have said earlier on, that markets are not static, prices keep on changing. So we need, as much as that, we also need to keep on revising our portfolios. The decision to perform changes in revising of portfolio depend upon other things. Okay, depend upon other things. In the transactions costs incurred in making these changes, for institutional investors, portfolio revision is continuing and very important part of their activity. Okay, so revision also has a cost, because assuming you want to step up your investment, there are those probably the legal processes that you have to undergo. You have also probably to advertise. You have also to pay some charges. So these are now some of the costs that needs also to be evaluated alongside the projects that we are advising. And so that as you go into that, you are aware of some of these costs that you may incur as a result of that. Managing portfolio must perform portfolio revision periodically. Periodic reevaluation of the investment objectives and portfolios based on them is necessary because financial markets change, tax laws and security regulations change, and other events alter stated investment goals. Yeah. Okay, things keep on changing. The legal laws keep on changing. The market is changing. Regulations are changing, and therefore we are also bound to change our goals, our investment goals, as a result of those changes that are in the market. Then lastly, we have measurement and evaluation of portfolio performance. Measurement and evaluation of portfolio performance. This process involves determining periodically how the portfolio performed in terms of not only the return earned, but also the risk of the portfolio. All right, not only the return, but also the risk. For evaluation of portfolio performance, appropriate measures of return and risk and benchmarks are needed. All right, a benchmark is the performance of predetermined set of assets obtained for comparison purposes. A benchmark is the performance of predetermined set of assets obtained for comparison purposes. The benchmark may be a popular index of appropriate assets, stock index, or bond index. So benchmark can also be the market, you know, the industry, look at the industry, the sector, all right? The market, like the stock exchange performance. So these are some of the indicators that may call for evaluation and measurement of your returns against now the index or the market price, so that you can make informed decision whether to continue the project or not. The benchmarks are widely used by institutional investors evaluating the performance of their portfolios. So these are the 5 key steps that we need to follow as we manage or we manage our portfolios or our investments. Now, in conclusion, we can say investment management process is a continuous process influenced by changes in the investment environment and changes in the investor's attitude as well. So it's also not only the environment or the market, it's also the attitude, all right? Different investors have different attitudes. So there are those who are risk averse, there are those who are risk takers. So you have to we can say this about this process, all right, being a continuous, and therefore some other factors may contribute to these steps being followed the way we have outlined them. Then market globalization offers investors new possibilities, but at the same time, investment management become more and more complicated with growing uncertainty. All right, uncertainty, which means there's a lot of things that cannot be easily predicted. So we are bound to change. Sometimes we want to expand abroad, all right? So you need to keep on evaluating your project and doing analysis so that you come up with the right decisions in terms of investment. Irma? Kadir?
Yes. Hello.
Do you have a question? Girma?
No, I don't have question.
Okay. So that is what I had prepared for our discussions today. And I will share the notes through your emails so that you can share to your colleagues.
Okay.
And God willing, next week we'll go into now the portfolio analysis in practice.
Okay, see you.
All right. Thank you, and have a good weekend. See you next time.
See you. Gracias.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጎታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።